The government just passed the biggest tax changes in the last 25 years, and most property investors are panicking. But the smart ones, they are already repositioning. In this video, I'm going to show you two completely legal strategies that seasoned investors are using right now to keep investing in property and work around Labour's new budget rules. Hi, my name is Deepak. I am a chartered accountant and a registered tax agent and principal advisor at ProPartners Accountants and Advisers. Every week, I help Australians cut through this tax noise and make smarter financial decisions. And right now, this budget is the biggest thing we need to talk about. And before I dive in, a quick disclaimer: everything I share today is general information. Please see your accountant or financial advisor before acting on anything because your situation is unique. So what actually changed? Two things. First, negative gearing on established residential properties. If you buy an existing home after 12th May 2026, you can no longer offset losses created from that investment property against your salary or any other income, at least not under new rules. The second biggest is the 50% capital gains tax change. Capital gains discount method is getting replaced by the new CPI indexation method, plus a minimum of 30% tax on those capital gains. This will come into action from 1st July 2027. Now here's the important part. Existing properties you held before 12th May 2026 are getting grandfathered. Roughly 7 million Australians still have the previous rule, protecting the current holding. So what are the two strategies that smart investors are talking about? Let's get into it. Strategy number one, SMSF joint ventures. This strategy involves your self-managed super fund. Now, you already may have heard that government has already banned SMSFs to borrow money to buy residential property. That's true, but here's what they didn't ban. Your SMSF providing a deposit on a new investment property while you personally borrow the rest. This is called the joint venture between you, an individual, and your super fund. You each own a share of the property and your SMSF owns the units funded by its contributions and you own the rest. It all has to be done at arm's length, meaning commercial term, paper documentation, no sweetheart deals. The kicker, because the property is a newly built, it still qualifies for negative gearing under new rules. You get the deduction on the borrowing side and your SMSF benefits from the lower tax rate, which is 15%. Now, is this for everyone? No, you need to have meaningful funds in your super fund and structure needs to be set up correctly. But for the right investor, this is generally an opportunity and a powerful combination. If you want to explore this, I would genuinely recommend you to talk to your accountant and a licensed financial planner who understand SMSFs. Now let's talk about strategy number two, negatively gearing your former family home. Strategy number two is much more flexible and it affects 7 million Australians right now. And here's the scenario. You own the home you live in, you bought it before 12th May 2026. Under the new rules, that property is grandfathered, meaning you can still use it for negative gearing in the future. So instead of selling your existing home, buying a new property, why don't you just move out, have the existing property on rent, and you can rent somewhere else? Now your old home becomes your investment property, and because you owned it before the budget night, you still get the negative gearing. Now this is not a one-size-fits-all strategy. There are CGT implications when you sell, particularly around the main residence exemption. So you need to model the numbers carefully. There's also one more update worth knowing. Independent Senator David Pocock secured a last-minute amendment to the legislation. Australians who inherit a property or receive it as a settlement of a divorce, they will also retain the grandfathering for negative gearing and CGT. These are really important details for the families who are doing estate planning at the moment or going through relationship breakdown. So to summarize, smart investors are playing through two main strategies right now: SMSF joint ventures for new builds and converting their grandfathered existing home into an investment property. Neither of these are loopholes. These are legitimate strategies. If you want to know how either of these apply to your situation, reach out to us at ProPartners Accountants and Advisors. And if you found this video helpful, I would appreciate a like or subscribe to our channel. I'll see you in the next one.